Silver holder are in trouble right now. Market warning just triggered. Something strange happened in the silver market recently that almost nobody is talking about. While mainstream financial media was focused on stock market headlines and Federal Reserve meeting minutes, a quiet but deeply important signal appeared in the silver market. A signal that, historically, has shown up at major turning points. Not always as a warning of collapse, sometimes as a warning of something else entirely. A shift in who controls the market, how it's priced, and who gets hurt when the mechanics finally break. Silver holders right now are sitting at one of the most unusual junctions in the history of this market, and whether what's coming is opportunity or danger depends entirely on whether you understand what this signal actually means. So let's start where most people don't. Not with the price, not with the headlines. Let's start with the structure underneath the market, because that's where the real story is. Section 1. The warning signal. To understand what just triggered, you need to understand how silver is actually priced. Most retail investors assume silver's price is determined by simple supply and demand. Miners dig it out of the ground, industries buy it, investors accumulate it. Price goes up when demand exceeds supply. Price goes down when supply is abundant. That's the version of the story you're supposed to believe. The reality is more complicated and more important. Silver's price is primarily set in a paper derivatives market, specifically the COMEX futures exchange in New York. Every day, enormous quantities of silver contracts are bought and sold between large institutional traders, banks, and hedge funds. The overwhelming majority of these contracts never result in actual physical silver changing hands. They are financial instruments, bets on price direction. And the volume of these paper contracts dwarfs the amount of physical silver that actually exists. Here is where the warning signal lives. Right now, the ratio of paper silver to physical silver on the COMEX, the number of contracts outstanding relative to the registered silver available for delivery, has reached levels that have historically preceded major market dislocations. When this ratio stretches too far, one of two things happens. Either the paper price collapses to reflect real physical reality, or the physical silver market seizes up entirely because there simply isn't enough metal to back the contracts. Neither outcome is comfortable for silver holders in the short term. Both outcomes have major long-term implications. But that wasn't the real story. The real story is what's happening to physical silver at the same time the paper market is flashing this warning. Section 2. The physical divergence. While the COMEX paper price has been under pressure, something very different has been happening in the physical market. Premiums on physical silver, the amount you pay above spot price for actual coins, bars, and rounds, have remained stubbornly elevated. In some cases, they've actually been rising. Dealers are reporting tight inventory on popular products. Retail demand from stackers and smaller investors has stayed remarkably consistent even as the paper price has experienced volatility. This is the divergence. Paper silver and physical silver are beginning to tell two different stories. And historically, when these two stories diverge significantly, the resolution has never been subtle. Think back to the events of 2020 and 2021. When the paper silver price briefly crashed during the initial COVID panic in March 2020, physical silver essentially disappeared from the retail market for weeks. Dealers sold out. Premiums exploded. The paper price said silver was cheap. The physical market said silver was almost unavailable at any price. Or think back further to the Hunt Brothers episode in 1980, when the attempt to corner the physical silver market exposed just how thin the line was between paper promises and real metal. The point is not that we are necessarily headed toward those exact outcomes. The point is that the divergence between paper and physical markets is a warning. It tells you that the pricing mechanism is under stress. And when pricing mechanisms are under stress in commodity markets, something eventually has to give. But here's what silver holders are not being told. The stress in the pricing mechanism is not happening randomly. There are very specific forces driving it, and they connect to something much larger than the silver market itself. Section 3. The macro pressure system. To understand why silver is in a precarious position right now, you need to zoom out considerably. The Federal Reserve spent years keeping interest rates near zero and expanding its balance sheet to historic proportions. That era of cheap money inflated virtually every asset class simultaneously: stocks, bonds, real estate, commodities, and precious metals. Then came the most aggressive rate hiking cycle in decades, designed to bring inflation back under control. What does that have to do with silver? Everything. When interest rates are high, the opportunity cost of holding silver increases. Silver pays no dividend. It generates no yield. Holding silver when you could be holding treasury bonds yielding 5% or more means accepting that trade-off. This is why rising rates create pressure on silver prices, and why many institutional investors reduced their precious metals exposure as rates climbed. But here is the hidden layer that most mainstream analysts ignore. Silver is not just a monetary metal. It is simultaneously one of the most industrially critical materials on the planet. Roughly 50% of silver demand comes from industrial applications: solar panels, electric vehicles, semiconductors, medical devices, aerospace components, artificial intelligence data centers, and military hardware. This is not speculation. These are documented, structural demand categories growing at rates that have nothing to do with monetary policy. So you have a market that is being pressured by high interest rates on the investment side, while being simultaneously pulled upward by explosive industrial demand on the other side. The result is a tug of war, and right now, the interest rate pressure has been winning in the paper market. But interest rates don't stay elevated forever. The Federal Reserve is watching economic data, unemployment trends, consumer spending, credit stress, corporate defaults. Every month that passes with rates at current levels is another month of pressure on the broader economy. And historically, when the Fed pivots, when it signals that rate cuts are coming, precious metals respond before the first cut is ever delivered. The market doesn't wait for confirmation, it prices in the expectation. And if that pivot is closer than the mainstream narrative suggests, silver holders who understood the warning signal may be positioned very differently from those who didn't. We'll come back to the Fed timeline in a moment, but first, there's something happening in the supply chain that almost nobody is discussing. Section 4. The supply crisis hiding in plain sight. Silver is primarily a byproduct metal. This is one of the least understood structural facts about the silver market, and it has enormous implications for anyone trying to understand where supply goes from here. Approximately 70 to 75% of silver mined globally comes as a byproduct of mining for other metals, primarily copper, lead, zinc, and gold. Silver is not the primary target. It's what comes out of the ground along with the metals that are actually being pursued. This creates a deeply counterintuitive supply dynamic. When industrial metals like copper and zinc face price pressure, mining companies reduce production. They shut down less profitable operations. They delay new projects. And when they do that, silver supply falls. Not because silver prices are low, but because the host metal prices drove the production decision. Silver has no control over its own supply in the majority of cases. Here is the implication that matters. Global silver demand, driven by the energy transition, by artificial intelligence infrastructure build-out, by defense manufacturing expansion, and by persistent investment demand, is projected to remain structurally elevated for the foreseeable future. The Silver Institute, the primary industry research body, has documented consecutive years of supply deficits. The market has been consuming more silver than it produces year after year. Deficits don't disappear overnight. They accumulate. They draw down existing inventories, and at some point, inventory levels reach a threshold where the market simply cannot absorb additional demand without a significant price response. Now connect this supply reality to the paper market warning signal from earlier. If physical inventories are being drawn down by genuine structural deficits, and the paper market is showing an elevated ratio of paper contracts to real physical metal, and industrial demand is continuing to accelerate, then the paper price is not accurately reflecting physical market fundamentals. That gap cannot persist indefinitely. But here's what makes this moment particularly significant. Something has changed in the geopolitical landscape that is accelerating the timeline on all of these pressures simultaneously. Section 5. The geopolitical acceleration. The world is in the middle of a monetary realignment. This is not a fringe argument. It is a documented, observable process involving the world's largest economies. The dollar's share of global foreign exchange reserves has been declining for decades. Central banks outside the Western financial system have been accumulating gold at the fastest pace in modern history. The BRICS bloc has been actively constructing alternative payment infrastructure. Trade settlements in non-dollar currencies are increasing. None of this is happening quickly enough to collapse the dollar system tomorrow, but it is happening consistently enough that the direction of travel is clear. What does this mean for silver? When confidence in fiat currencies erodes, when governments debase their currencies through spending and money creation, historically, real assets benefit. Gold benefits first as the monetary safe haven. Silver follows, amplified by its dual role as both monetary metal and industrial commodity. More importantly, as the geopolitical competition between major powers intensifies, the build-out of military hardware, energy infrastructure, and technological systems that all require silver is accelerating on multiple sides simultaneously. This is not a single country's industrial policy. This is a global arms race of technology and infrastructure that has silver embedded throughout its supply chain. The countries that are most aggressively building out solar capacity, electric vehicle manufacturing, and defense electronics are also the countries that are most aggressively accumulating physical precious metals. That is not a coincidence. And here is the layer that connects everything. If the paper silver market is being used to suppress price signals, allowing large institutional players to acquire physical metal at prices that don't reflect genuine scarcity, then the current warning signal in that market is not just a technical anomaly. It may be a visible seam in a system that is under increasing structural pressure from multiple directions simultaneously. Physical holders of silver own the real thing, not a contract, not a promise, the actual metal. In a world of paper promises, that distinction may matter more than it has in a very long time. Section 6. The historical parallel. History has a pattern in silver markets. Long periods of suppressed prices, driven by paper market mechanics and institutional positioning, followed by sudden, sharp repricing events when the physical reality can no longer be ignored. In 1979 and 1980, silver went from under $6 to nearly $50 in under 2 years. The catalyst was a combination of inflation, monetary uncertainty, and a physical squeeze. In 2010 and 2011, silver again ran from under $20 to nearly $50. The catalyst was quantitative easing, dollar debasement fears, and a surge in physical demand that overwhelmed paper market assumptions. Both of those moves were preceded by exactly the kind of structural stress signals that are visible in the market today. Elevated paper-to-physical ratios, rising premiums, supply deficits, monetary uncertainty, geopolitical tension. The timing of those moves was not precisely predictable. Nobody rang a bell at the exact bottom. The people who benefited most were not the ones who timed the market perfectly. They were the ones who understood the structural setup and positioned accordingly before the repricing event. The people who got hurt were the ones holding paper promises when the physical market seized up, and the ones who didn't understand the difference between price and value. That historical parallel is not a guarantee of anything. Markets don't repeat exactly. Circumstances are always different in important ways. But the structural rhyme between past setups and the present moment is too significant to dismiss. Section 7. Present-day implications. So what does all of this mean right now, practically, for silver holders and those watching this market? First, the warning signal in the paper market is real. The elevated paper-to-physical ratio, the rising premiums, the documented supply deficits, these are not manufactured by fear or speculation. They are observable, measurable data points that institutional analysts are tracking carefully, even if mainstream media is not covering them. Second, the macro environment is at a potential inflection point. If Federal Reserve policy shifts toward rate reductions as economic conditions evolve, whether driven by a slowdown in growth, credit stress, or labor market softening, the investment case for silver strengthens considerably. Historically, the window between a Fed pivot signal and the commodity market repricing can be relatively short. Third, industrial demand is not going away. The energy transition, the artificial intelligence infrastructure build-out, the defense manufacturing expansion, these are multi-decade structural demand drivers. They don't reverse because of a few months of paper market volatility. Fourth, and perhaps most importantly, the geopolitical context is not neutral. The global monetary realignment, the de-dollarization trend, the central bank gold accumulation, the infrastructure competition between major powers, all of these are long-term tailwinds for real assets, including silver. The question for silver holders right now is not whether the fundamental case is intact. Based on the evidence, it is more intact than it has been in years. The question is whether they understand the difference between short-term paper price volatility and long-term structural positioning, and whether the warning signal that just triggered is a reason for panic or a reason for clarity. Section 8. Future Scenarios. Let's look at how the next phase could unfold. Scenario 1. The Fed pivots earlier than the market currently expects. Economic data deteriorates. Credit conditions tighten. The Fed signals rate cuts. Dollar pressure builds. Inflation remains elevated relative to targets. In this scenario, precious metals typically respond strongly. Gold moves first. Silver follows with amplified velocity, given its dual monetary and industrial demand drivers. Physical premiums compress as paper prices rise to meet physical reality. The warning signal resolves to the upside. Scenario 2. Rates stay elevated for longer. Economic resilience persists. The paper-silver price remains under pressure. Physical holders experience continued paper price volatility. Industrial demand, however, continues growing regardless of interest rate policy. Supply deficits continue accumulating. The structural tension builds further. The eventual repricing event, when it comes, is larger in magnitude because the gap between paper price and physical reality has grown wider. Scenario 3. A credit event or financial shock creates a sudden flight to liquidity. Paper silver is sold along with most other assets in a rush to cash. Physical silver briefly becomes even harder to acquire at spot price. The short-term pain for paper price metrics is significant, but physical holders who can withstand the volatility find themselves holding an asset whose long-term fundamentals were unchanged by the panic. In all three scenarios, the structural case for silver remains intact. The timing and path vary. The destination, if current conditions continue, points towards significantly higher valuations for physical metal. What changes between these scenarios is not the fundamental answer. It is the patience required to reach it. The final insight. We started this video with a warning signal, a signal hiding in the structure of the silver market, beneath the paper price, beneath the mainstream headlines, in the gap between what the futures market is pricing and what the physical market is saying. That gap is real, it is measurable, and historically, it has not persisted indefinitely. Here is the deepest insight from everything we've covered today. Silver sits at the intersection of three of the most powerful macro forces of the current era. The monetary system is under stress and slowly being restructured. The industrial economy is consuming silver at unprecedented rates, driven by energy transition and technology. And the paper markets that set price signals are showing visible strain between their promise and the physical reality underneath. Most investors are watching the price. Very few are watching the structure. The people who will look back on this period and say they understood what was happening were not the ones who predicted the exact date of a price move. They were the ones who recognized that the warning signal had appeared, that the fundamentals were aligned, and that the difference between short-term paper volatility and long-term physical positioning was the most important distinction they could make. Silver holders are in a complicated moment right now. The paper market is under pressure. The macro environment is uncertain. The headlines are noisy. But underneath all of that noise, the structural case for physical silver, real metal, held directly outside the paper system, has rarely been more clearly supported by the evidence. The warning that just triggered is not necessarily a sign to run. It may be a sign to pay very close attention. This video is for educational and informational purposes only. Nothing in this content should be construed as financial or investment advice. Always conduct your own research and consult with a qualified financial professional before making any investment decisions.